Good morning, everyone. This is the Futures in 5. Today is Wednesday, March 6th. We're starting a look at the ES. I want you to take a look at overall what kind of motion we have. It's very compact, very sideways. There's no real trend sitting here, and you can look at that by just taking any kind of line across the horizon and seeing just how many candlesticks you run through with a horizontal line. That tells us a lot about how sideways the markets are and essentially what might be going on in general. So let's take a look at this. Overall, if we take a look at our bigger picture expanding out, we can see we are holding support and testing resistance. When we pull back into support, we find buyers. When we breach up into resistance, we find sellers. So we are landlocked. As traders, if we're looking for trend, the only kind of formations that open up trending areas come on much tighter time frames. Here's something that makes these wicks really very likely all the time. Downward motion in our momentum indicators, upward to flat motion in our moving averages. That tells us that we have wicks that are very likely to occur. Breakouts, not to hold, pullbacks and breakdowns, not to hold. Everything is in a reversal pattern on the edges until it's not. And so what that means is you have to be cautious with your size. Those of you using our instrument levels, notice I'm talking about engaging in aggressive entry formations. And I know that seems contrary, but trust me, that's what's working right now. So we'll keep doing what's working until it stops working, right? That's just the way we have to roll in the market. VPOC to watch is around this 27.92 to 27.97. That's been ideal resistance, ideal support, 27.84. It's been pretty much lockstep day after day in terms of overall motion. Same sort of thing we're looking at in the NQ, landlocked. Different kind of landlocking though, because look at where these moving averages are. They're underneath price, so they are holding as support. You know, a lot of people use moving averages. I asked a question the other day in the trading room, why does technical analysis work? And there's a very circular answer to that. And technical analysis works because people use it. If they didn't, it wouldn't, because there's nothing magical about these little points. Everything is about price and its relationship in the environment in terms of volume, speed, motion, range. All those sorts of things give us information. But if we don't use that information and assess it in a certain way, it simply will not work. And so it's sort of a self-fulfilling kind of information, which really makes it a zero-sum game if you're not trying to exploit these edges. And so these edges have been buy on the deep support action, sell at the resistance in this area until it becomes definitive. Take a look. If I've got upward motion on my moving averages, a dip in price that says I'm in a reversion to the mean event, and a dip in momentum, I've got cross currents, and we really are in the space where I believe that we are working off a little bit of the heat. So it's going to be reversion to the mean. This support action still holding, this resistance action very high here. Now we might say, hey, we are sitting underneath all of the moving averages, and we're likely to have reversion to the mean in play today across the board, coming back into the very noisy sections right here. We have a little bit of positive divergence, we have a little bit of negative drift, we have a ton of sideways action. So what does that mean? Pull back into the support, and you say to yourself, hey, if it comes in there, I'm going to have a tight stop, and I'm going to go for it. I'm going to take it to my resistance areas, and I'm going to get out of the trade. Really straightforward, very unemotional. You just give yourself the shot to move in where the market is telling you. For oil, this is very interesting. A lot of hedge funds really talking the game about moving back into oil. Of course, hedge funds use the forward contracts a lot to position themselves and use the near-term contract to hedge themselves around the region to create relative alpha. So what are we looking at? Bullish moving averages, bearish divergence, range tightening. This was the range I had yesterday. It's broken through it. I don't want to change that, because here's the thing. If we bounce into this area like we did this morning and we can't hold it, we are holding it so far, just so you know. If we can't hold this edge, we're going to dip into deeper support. What are we showing? Negative divergence, a very messy patch. Today's the EIA at 10:30. I have no idea what this number is going to be, but probabilistically, here's what we're looking at. Any big spikes going to reject at the first pass. That means the first time it comes up into these new areas, you're going to watch it start to resist, and it's going to come right back down into the congestion zone. Same thing on the downside here. If it digs really deep, we know overall oil is bullish in its motion, and so we're looking for old resistance, new support. That was all the way up here at 55. But if we have something dastardly or they just decide to sell off, we could come all the way into here. So you want to watch this momentum event. Last one we're going to take a look at is gold. Listen, we've been talking about gold trying to hold this level for days. So what's happening here? If this is a big bounce zone, why isn't it moving? And there's a sense here that what price action is telling us is, take a look at the size of this wave. Okay, the size of this wave is 1,000 ticks. Gosh, no, it's 1,300 ticks wide. It's a lot, right? There's 150 points here, so it's really almost 1,500 ticks in this formation pulling back. So this is a very big move. If we take something like a Fibonacci and we take a look at, well, what might this chart be doing? We would look at it and go, you know, my 50% retracement is down here at 1270. That's a fairly good level, right? The 50%, 61% is even more ideal. And the 70.07, which is a real Fibonacci number, gives us old resistance, new support. Now, is it likely that we fall all the way down here? I don't know. But here's the lovely thing. If this bounces and cannot get up over the 38.2, which is 1296, which is what we have not been able to do for a couple of days, it tells us our price action is likely to have another leg lower. And so we are going to be watching for those things. This is just working off some very, very big moves, and so it's taking some time. My thought is, if you are uncomfortable with buying at the low and selling at the high of this range, do not get involved. Wait for it to break, fail the retest, and engage in the direction of momentum, or to give you more positive divergence, allow it to break up and over the 92 to 94 area, and on the pullback that holds 90, you're able to engage. Does that mean you give up a potential 9 points? Yeah, but you also give yourself a great deal of headache that is now out of the way completely, because you do not have to worry about, oh my goodness, do I have to get out right here, or am I going to get back all my gains? All right, good luck trading today.